Hello guys, Happy New Year. Hope this year will be prosperous for all of us. This is the second part of Ichimoku Cloud episode or series, whatever you say. The first part I have explained how the Ichimoku works and what are the things we should consider, especially the trading mindset. What does the Ichimoku Cloud means and how to use it, and the primary rules of engagement. The second thing we in the second part we will discuss especially uh, two things. In the initial portion of this part we'll discuss the cloud especially, and in the second part we'll discuss how to determine the stop loss. And if possible, we will see the different support and resistance we have done in our first part, how to use them. Let's see. I don't want to make the video very long because most of the people doesn't want to see the long video. Anyhow, the first thing is this. Let us take out all the other things which we don't want to discuss right now: conversion line, baseline, and lagging span. So this is the cloud we have now. So what is this cloud? This cloud give us the indication very clearly that where the support and resistance are within the system of Ichimoku Cloud. So this is AUD, Aussie dollar, and Japanese yen. You can see there this is a very straight line in red. Let me change the rectangle color. So the line in the middle is the, no, this is not the way to show you the exact thing. Let me use some other tools. This guy, you can see this this red line. This red line is the lower side. I mean the if we see that, by definition we call it lagging leading span A and leading span B. This is leading span B. So this leading span B is always red and leading span A is always green here. So this red line is a very strong support in terms of Ichimoku Cloud system. And you can have this reflection here, that each time the price came down here, try to break this red line, again the price retraced. You can see here, here, and then it retraced back and started moving upward. And if you see the same thing, whenever the price goes down beyond this red line, the price shows some upside momentum. And so as we are currently, if you can see, we are currently in a downtrend. If we consider the day time frame, here you can see this is a day time frame. This is 1 day time frame. This same red line becomes a resistance. So once it is broken, each time the price wants to move upward, in how many days? You can see 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 times the price has been rejected. So this is a strong support and resistance considering the time frame and the price action. If you can see, it is a downtrend and the price wanted to break out. The initial resistance is this red line and secondary resistance is this green line if we consider the 1 day. On the contrary, if we go to 4 hours, we can see that this, the same thing, the same red line is working as a support due to changes the time frame coming from 1 day to 4 hours. Each time the price wants to break this one, and it got rejected here and it is trying to move upward. We'll see later how we can sync the time frame to align each other so we can increase the probability of our trade in our favor, either going long or short. So this is one thing. So each of this line, the red line and this green line works as support and resistance considering the price action. If we move a little bit backward, we can see that how the green line works as a what you say as a support and resistance. And here you can see that the green line, where is the green line? It is working every time, it is working as a support here. You see, and again when it is broken, it works as a resistance also. So once the green line or red line is broken, either it will work as a support or as a resistance. This is number one. So the second interpretation of the cloud is, the more thicker the cloud is, the more supportive will be the cloud. It means if the price is above the cloud and it has a very thick cloud like this, then whenever the price comes back to this thick area, it will get a great support of this whole cloud range. You have seen that the price has came down like anything here and it got bounced back from this inside or a little bit below the cloud and returned back, retraced on upside. And again the same thing, the cloud is thicker here, so whenever the price got here sideways, but when it broke down, you see the price once broke down here, this particular area, then whenever the price wanted to go upward, this cloud, the whole cloud area works as a resistance. So the thicker the cloud, the more resistive it will be depending on the market direction, and if the market direction is bullish like this, if it goes down up like this and it is coming down, this cloud will work as a support. And at the same time, if the market comes down like this, where I could have been showing you a better example. Here you can see, you see, it's a very long, you see, the market came down like anything here, and it wanted to go up. It taken a lot of time here with the inside the cloud, and then it break out of the cloud, and the whole cloud is working as a support. Plain and simple, this cloud is working as a support for a long, we can say a very long time. So this whole cloud is a support, and the support, and on the contrary, here we can see when the market direction is in downtrend, this cloud worked as a resistance. It didn't allow to move the price so easily upward. So this is the functionality of the cloud. The thicker the cloud is, the more it will act like a resistance or support depending on the direction of the market. And another thing, if the cloud is thin like this, it is very fragile. It means that it will not be as good as a support or as a resistance. If we can see here, the cloud is very thin and the market came down very easily, went up easily, came down easily, went up easily. So when the market, the cloud is thin, the market is basically going on a ranging. Especially if you mark this, we can see this. It has been ranging for a long time. You see, in 4 hours, it was ranging from uh, 8th October to 24th, 7th November. Whole 14-15 days here in 4 hours time frame it was ranging here, because the price was playing breaking the cloud very easily due to its density is very thin. You see, this is so the catch as far as cloud of Ichimoku is concerned. The thicker the cloud is, so like, we should write it down so you can note down if you want to. One, the thicker the cloud, it will be a strong support or resistance. So this is number one. And number two thing, the second thing we can say, the thinner the cloud, it will be a weak support or resistance. The price gets, or not say, starts ranging once the price is inside the cloud, or if the cloud cloud is thinner, it is fragile, will not give any trend indication. So these three things we have to keep in mind. Okay, the thicker the cloud, it will be a strong support or resistance, subject to market subject to market direction. I mean bullish or bearish. And the thinner the cloud, it will be a weak support or resistance, again subject to market direction, that is bullish or bearish. And the price starts ranging once the price is inside the cloud, or if the cloud is thinner, it is fragile, will not give any trend indication. So these three things we will keep in mind. So whenever we take a trade, these three things will increase the probability of our trade if we consider these three things. So this is number one. Number two is this, as I have discussed very clearly, that this technique or strategy of Ichimoku Kinko is mainly based on for the swing trader or a structural trader, not for daily traders. So as far as the stop loss and trailing stop loss is concerned, is a very very difficult thing to set initially, but once you understand, you will get it very clearly. So there is initially the best option is to go for as it is, we are doing swing trade, so the depth of the trailing the stop loss will be very big, but at the same time the reward will be big too. So there is we will discuss about the stop loss, how to set a stop loss and how we can trail them. First of all, most of my trade I take on the basis of daily, but I take the trade on the 4 hours chart price action. So I will show that later. Let's say as I take the trade in 4 hours, how do we do that, the trailing stop? So you have to choose a ATR range probability. 52 EMA bottom right normal. This is based on 52 EMA exponential moving average. This ATR probability is designed, and this is the chart you can see. So if I take, let's say I want to take a trade somewhere, I should enable the other indicators so we can see where we can find the trade and where the stop loss should be. I hope this clumsy thing doesn't bother you anymore. This is the lagging span. The blue one is the purple one is the lagging span. The blue one is the conversion line. The yellow one is the baseline, and this is our cloud, the leading span A. This is the green one, leading span A, leading span B, and in between it is the blue line. So as far as 4 hour is concerned, we can see that there is no trade here, because the price is inside the cloud, not it is below the cloud or above the cloud. Also the conversion line, baseline are inside, so none of our criteria fulfilled. Primarily we have discussed in the first part. So any trade we take, we should go for the ATR value. So if we go for day, so current price is 97.71. This is the day highest it has reached. So rather than discussing all these things, we will go for ATR 100% positive or 100% negative. So 96.6336 is our ATR. If we have taken a trade here, then our what you said that our 96.63, where is 96.63? Come down here. It will be somewhere here. I need to take out something here, which I will explain why. So this should be our stop loss. So if we want to take a trade, forget about that. Let me take out the whole thing. I don't know. So if we take a trade here, so the ATR value should be negative 100%, which is 96.63. This is the place where we should put our stop loss. Based on ATR, this is the best option. On 4 hours chart, we can do that, something like this. So this is one way to set stop loss. So let us put one by one. So how to determine the stop loss? This should not be one. So one is based on ATR negative 100% for long trade, for long, and positive 100% for short. Positive 100% means if we short it, if we expect the market to come down, then our stop loss should be 98.80. So where it will be? So it will be here. You understand? Considering the price. So going short, we will put the stop loss here, and going long, we should put our stop loss here. So that is the based on ATR. If we do that, that is the simplest form to do that. Where is my text? I don't know. What happened? Oh, it is gone. So let's bring it back. So if long, it should be negative 100% of ATR, and if short, it would be 100% positive of 100%. Why did I put so many brackets? So in this example, we have found it very clearly. What we have found? We have found this, that going long, the ATR, the stop loss should be 96.63, and here you can see 96.63, negative 100%, and for short we should put our ATR positive, that is 98.80. This is one method, very crystal clear, very crystal clear. You don't need to be confused. Just enable this indicator in your TradingView chart, and you can find this guy here, and you can put the stop loss. And as per our primary rule of engagement, we always should put our stop loss. Okay. Second thing is this. The second thing we can do, that if the ATR is very weak from our actual price, either on the top side going long or short, the second best thing we have just discussed a few minutes back, that we can use this line. But this line, you can see if we go long, this red line works as a support, but it will blown away. That's why ATR based what you say stop loss is very good. Now once you set the stop loss and it is done, let the trades play on. Now how about the trailing stop loss? In case of trailing stop loss, always for short we will follow this yellow line. Always we will follow yellow line, not exactly like this, not after each bar we should change. No, we will follow this guy, okay, then again we will follow this area, then again we will follow this area if we go short. And initially we can put the ATR on the based the trailing the stop loss based on ATR, or we can give here, but here it will not work. You can see it has been taken out so many times. This red guy has been taken out so many times. So trailing stop will be based on the baseline, and whenever the baseline is shows a very straight line, that straight line works as a very strong resistance for the short. And on the contrary, if we have a let's go somewhere here, you can see trailing stop. For trailing stop we will always use the initial stop loss will be based on ATR, and after that if you keep on the trade open, you should always follow the straight line of the this baseline. This is a very good tested and trialed, you see, and here it has never reached here. You can see even the price came down and even it bounced back, and once it goes up and you have again another stop loss here, and the next time it came down, the trade will be closed here for the long. Okay, so this is another thing. So we can put something like this, that mm, and in some cases you can also guided by the cloud. This cloud also works as a very good trailing stop loss. But most of the cases I have found the baseline is better to be used as stop loss rather than the cloud, because it takes huge toll. The stop loss will be very big if it comes here, and if you give the stop loss here, then we are talking about losing almost here we are 354 pips. That's huge. That's huge. We cannot do that. So we'll minimize something like here. Here we will provide the stop loss, saving this much at least. So this is the thing, and once the price is always, so let's put it the concept of trailing stop loss here. After the initial stop loss, please use the baseline, which is the yellow curve here, as the trailing stop loss. Okay, so either it is long or short. If it is short, you will use this line as a trailing stop loss. If it is long, we will use this line as a stop loss. You can see this is the trailing stop loss for short. This is the trailing stop loss for long. So this is two things. And third thing is here, you have to keep in context. You always open two trades. Now I don't know your investment amount. So if you try to open a trade, the best option is to open 3% of the investment. And the reason for is you will close 1% once the initial target is achieved. Now what does that mean? It means that normally what we do, let me increase the size of the whole chart so I can explain it better for you guys. So here we can see that the price came down, breaking below the cloud. The blue line was below the yellow line, and also if we see the consequent, that what you call the lagging span was also below the 26th price. So if we open a trade here, our stop loss based on ATR should be somewhere here as per the ATR. I don't know the exact ATR value, and we will always go for 1:2. So 1:2 means that if we lose, the ATR value is 100 pips, we will target our profit 200 pips. I repeat it. If we open the trade here, exactly here, can you guys see or not? I don't know. Let me check. If you open the trade here, as it has crossed here and both are above one each other here. So if you open here, somewhere here the trade, your stop loss will be here and your target profit will be 202 times of that stop loss. So let's say you have achieved 2 times. So you will close 1% of your trade. Then you will move your stop loss from the previous place to the place of opening your trade. So what happens here? Your 1% you are making 2 times of your profit, and for the rest 2% you are risking nothing. Either you will not make any profit out of the whole trade, or you will not make any loss at least. So again, you target from there, from your stop loss, the price will be 100% on the downside, and you target again another 200%, 2 times of that stop loss. So again, if it reach that next target, you close another percent. You understand? This way, what will happen? If you can close after the all 3% in the first place, but this way you will be able to generate more money, because you can see, if I target, let's say from here to 100 pips, let's say the stop loss was here, okay, 100. So our target will be, what will be our target? Our target will be from here to 200%, 200 pips. So we can close everything here, but as we are using this as a support, and we can see that support has not broken here, so we can close 1% of our trade and keep on running the another 2%, because it has the potential to make more profit. But to secure our position in loss, because one of the biggest motto in forex trading and any other trading, either is stock, future, whatever you option, whatever you trade, you have to safeguard your capital first. You have to safeguard your capital first. So initial 1% give us the safe exit of the whole trade after reaching the first target, that we will not make any loss. There will be no erosion in our capital. So we reached here. Let's put it here. We reached here and we closed the trade 1%. Then we move our stop loss from the previous 100 pips to here in this area. Let's not use this one. We can move the previous to our this area, the stop loss, and our trade is still running here. Okay. So if we again target from here another 200 pips for the sake of discussion, and let's say it reaches here, so we'll close another 1%. Okay, another 1% will be closed. So in the first one, we made a profit of 100 pips, 200 pips. The second one, we made a profit of 400 pips, and the third one maybe we'll make not 400, maybe 300 or 200, as long as the price is below this baseline, the yellow line. Once the price hit here, the price hit the yellow line, the last 1% will be, the third 1% will be closed here. So this way we maximize our profit all the time, and this is the practice you have to maintain all the time. Open a trade with your investment, 3% of your investment, and the initial stop loss will be based on ATR, and the target will be 2x of ATR. If the ATR is 100 pips, you will target 200 pips. Once you reach the target, close the first 1%, then again move your stop loss from the initial one to the point, to the price where you have opened the trade, and move your target again 200 pips, and once you reach there, you close the second 1% and leave the rest, the third 1%, to targeting this yellow baseline to decide its fate. I hope it is very clear for you how these things is done, how the trade has to be done. Third thing, never take any trade when the lagging line is inside or very near to the price. The more near to the price, the lagging line, the market will be ranging very much. You can see very near the price, the lagging line is very near to the price. The market is ranging. But if we want to get a very good trend, the lagging line will be always very far from the price. This is very important. So you can use lagging line as your indicator too, rather than waiting for the price to close based on your line. Once the lagging line gets in touch with the price, you close the trade also here. You understand? So this lagging line, most of the case I have seen people that they don't use lagging line at all. But you can see that this lagging line, this line gives a very good indication where we should close the trade. As far as the lagging line is away from the price, it is very good to continue the trade. Here, if we go in uptrend, you can see the lagging line. You can see, guys, the lagging line is away from the price. This is the price, and this is the lagging line. So once the lagging line touches the price, close the trade. You can use lagging line as a stop loss too. But you need, I beg your pardon, but here you need a continuous supervision. You have to watch it every time, because there is no stop loss you can set based on the lagging line, and that is the setback. So people who spend a lot of time trading online, they can use lagging line as their stop loss. Now that's it for today. In the third episode, what we will do, we will try to see things about no, I beg your pardon, that's not it for today. I'm supposed to discuss something else also, and which is our monthly, weekly and daily support and resistance we have drawn, and how they affect our trading decision. That's also important. So let's open one by one. Let's go to our let me turn them one by one. Hold on a second, I need to do something here, because I know what I have done. 30 minutes, all of them should be open. So here we have, this is the monthly resistance, and this is resistance, this is support, this is weekly support and resistance, and daily, this is daily support and resistance we have drawn. So initially we will just consider this one, so to visualize it in hourly, daily, weekly, monthly, we just turn them on here, and also we will turn them on here. Okay. Okay. Now going back to 4-hourly, we can see a lot of things. Now guys, if I have drawn a lot of things, my dear. I have to delete all of them to make the chart very clear for you guys to understand. Okay, here what is the use of this daily support and resistance? We have our support and resistance inside cloud. We have the support and resistance based on the baseline, the yellow one. We have the support and resistance based on the lagging line. But you guys can see that if the price for any reason, this is the daily resistance we have marked, for any reason it comes here, we must get caution. We must be alerted. We should not take any trade here until it clears out certain other condition. At the same time, if this line is broken, this here based on this line. If for any reason this line is, the price comes down from here to here and breaks this line, then we have to reconsider our trade for closing the trade, or we should not take any further trade until we see the reaction of the price based on this daily support. So that's why I have put this support and resistance on daily, and you must turn it on, at least the daily one. But once the daily is broken on the downside or on the upside, then we need to check the weekly one, how the weekly one will be responsive, because the weekly resistance will be much more higher here, maybe here, and the downside it will be here. So again we have to take trade based on those, considering that support and resistance of the weekly support and resistance. And the important part is here, these are very crucial thing to be considered. Remember, always remember, these are very crucial lines to be considered, as our price is far away right now from the support, from the resistance. So I removed it, leave the support here so I can visualize whenever I want to do. Okay, so this is the price, current price at the moment, and this is the support line of the daily. Now there is an interesting part of the ATR. There are 4 lines of the ATR available, and you guys can use them. It depends on your choice. These are the 4 lines, and these are dynamic support and resistance. After each day it will change. If you go to 4 hours time, after each 4 hours it will be dynamically change. That is the beauty of it. So always, if you go for long, you watch for this line and this line. If you go for short, you watch for this line and this line. Price will show some sort of reaction coming to this line if you go for short, and this line for short. And if for long, the price, if comes down to this level or this level, will show some sorts of reaction. So these are dynamic, these are not static like this one, this guy, this blue guy, which is a daily support. It will not change, but this guy will change based on the time frame. In every day it will change now dynamically. The next day the value of these 4 curves will be changed, and in 4 hours this will be changed in the next 4 hours. This is the way. If we can see some other pair, I can show you the price reaction of them very clearly. You see now, this is GBP, Great Britain Pound, and JPY. You can see that the price coming down here is showing some reaction immediately, as it was a very good uptrend, broken the cloud, and this is here, it is showing some reaction. So for short term, maybe for this is not for swing traders, this is basically for day traders. They work here very well. You can have a range. If you see the price here, and you can put your stop loss here, and you can target this guy or this guy for getting long. Or for downtrend, this is the place where you can make it short, putting the stop loss here or little bit up, and target this guy or this guy. Okay, so this is another way, but most of the cases I don't use them, but I'm giving you the way to how to use these 4 lines. So that's it for today. Thank you very much for watching, and if you think any of this discussion is helpful for you, or any of the thing you didn't understand clearly, please let me know in the comment section. I will be delighted to explain it once again. And in the next episode, we will try to see that how the breakout trade can happen now, and how to take the breakout trade, something like this is we call a breakout trade, something like this guy. You can see this is 4 hours chart. The price was here, and it just peering down the whole cloud and break the cloud and go. So this is a very strong indication that price will come down a certain level. Anywhere you can see that the break there you can see guys, the price was here and it was just, this is a breakout trade, you can see. And how we can take the breakout trade, how to play it safe, and all these things we'll discuss in the third part. Thank you very much. Happy New Year once again, and I will be very delighted if you are kind enough to subscribe and give likes to the video.